I would say that yesterday's move was mainly a function of interest rates, and so we went from 1% on the 10-year very quickly to 1.6 intraday last week on the 10-year, and so pulling back to about 1.4. I think it's a small move, but it means a lot. And so yes, I think that that backup in rates to 1.6 is overdone, largely a function of what happens every now and then, which is talk of inflation, and we can talk more about it. I think that the idea that inflation really picks up in a meaningful and permanent way is there's certainly no evidence for that, and don't see that happening. But I think that yesterday's move was just kind of a pause in the worry about a backup in rates.
Yeah, and I wonder if investors should not read into yesterday's move too much because, by the way, the first day of March last year, stocks also ended the day higher by around 2 to 3%. And then we know what followed, a bruising month for the month of March in 2020.
Right.
Do you think history could repeat itself?
A bruising month? Well, no, I don't. I mean, it's hard sometimes to separate what you hope will happen and what you think will happen. I hope not, and I don't believe that will be the case. I mean, obviously last March was, this would be the polar opposite of last March. We are now kind of going in the right direction with a third vaccine. And I think the sense is that this is all happening a little more quickly than people would have thought just 2 or 3 months ago. So I think that, there's certainly no exogenous event like a pandemic that is going to get in the way of what's been a good start to the month.
So then you say with the Dow trading above 31,000 and the S&P 5 and the NASDAQ above 13,000, that this market still has more room to run, working off this trifecta of that stimulus bill getting passed and moving forward to the Senate, and B of A now putting out that new growth estimate for 7.5% U.S. GDP for this year. Is that what that's your bullish thesis here?
Yeah, I mean, it's interesting with growth because I think that that's being underestimated. It's hard. It's always hard to model in what growth will be. And I think even, right now there's so much pent up demand. So yeah, I think that growth and, the expansion of margins, and where we are with rates and multiples. So rates at 1.4 on the 10-year, still historically low. It's about where we were when the pandemic started or right before. To put that in context, we have about a 4.5% earnings yield on the S&P. And so when you look at that versus the 10-year, that relationship is pretty much just as good as it was before we started talking about the pandemic. And then a lot of cash on the sidelines. I would note, S&P 500 about $7 trillion on the balance sheet, and private equity at about $1.5 trillion. And that's an unlevered number. So I think there is a lot of, wind at our backs. And the growth, I think that,
and Josh,
when I hear about growth, go ahead.
On growth, what's your best stock pick right now?
The stock pick. So, looking at our Hennessy Midcap 30 fund, looking at, we in that fund look at valuation and earnings growth and stock price momentum. I would point out Quanta Power Services, growth in kind of the high single digits, trading at about 19 times earnings, and certainly some significant stock price momentum recently. Quanta sits at the nexus of some interesting trends, very timely. It is an infrastructure and services company, mainly for utilities. So as we saw in Texas recently, about 2 weeks ago, certainly highlighted the need for grid hardening, to deal with adverse weather, as well as modernization. And, as we hear, more and more the integration of renewables. So I think that a company like Quanta is interesting. And speaking of stimulus and infrastructure spending, I mean, that is obviously, again, very timely.
Shepard Smith here. Thanks for watching CNBC on YouTube.